Now let's go through an exercise where it's an original issue discount, but there is a coupon payment as well. So on January 1st, 2015, Lemonade Stand Enterprises issues a 5-year 5% coupon bond with a $10,000 face value and $9,579. So here the difference is there's a 5% coupon and there's still a bit of a discount being issued. Make the same assumptions about the loan maturing January 1st, 2020, assume a 40% tax rate. Give this a shot yourself. Now that we've walked through one exercise already, hit the unpause button and we'll go through it together as a group. So here we go through the exercise where there is a 5% coupon bond, but there's still an original issue discount. So we're going to lay out the same inflows and outflows. So let's actually move this all down so we can label this inflows, outflows. And then this is the period. And in fact, I'm just going to go grab the same labels as before because it is the exact same story. So let's scroll that up. So in this case, the difference, and I'm going to move this to the side. So in this case, there's that initial inflow of $9,579 with the original issue discount. But then during each period, there's actually going to be an outflow. This is from the perspective of the company. They're going to have to, at first they get $9,579, but then they get $500. They have these obligations, 5% of the $10,000 face value. And so this is a $10,000 face value bond. Every year has a $500 coupon payment that's required. And in addition, at the end, not only by year 5, not only is there that $500 requirement, there's also the redemption of the bond. The bond is maturing and you have to pay the $10,000 in addition to the interest rate. So those are all the outflows. And so the implied interest rate here is not just 5%. It's not just 5%, which is what the coupon payments would have indicated, but it's higher because of that original issue discount. So for example, if there was no original issue discount, if there was no original issue discount and the company just received $10,000 initially, it would just exactly be, the IRR would exactly just be that 5%. But because there's that original issue discount of $9,579, or I should say of about $421,000, bringing the original issue to $9,579, the implied interest rate, the implicit interest rate is a little bit higher. And so here, interest expense is comprised of two components. One is the traditional cash interest payments of $500 every period, right? And then the other component is amortization. And amortization here is a little trickier than in the prior exercise. Amortization is going to be a function of the implied interest rate times the loan balance minus the portion of that interest expense that is already paid in cash via the coupon. And so it's whatever exists in excess of the coupon payment. So the way to sort of make sense of that, if that's a little confusing, is let's look at the calculation, this calculation on the side. If you simply take the implied interest rate times the original loan balance, you're getting an implied interest expense of $574. And under both US GAAP and IFRS, what that means is we're not recognizing a sufficient amount if we were only to look at the coupon payment on the interest line. In other words, we're off by 74.7, and that incremental amortization needs to be recognized from an accrual perspective. So what we're going to do is we're going to reflect our pre-tax income. We have to make an adjustment for the calculation here. Interest, the pre-tax income was revenues minus expenses minus interest expense, both the coupon and the amortization. We're going to copy that across. So now taxes reflect both the interest expense, coupon, and amortization payments, getting you down at a 40% tax rate to taxes as illustrated, reducing your net income, and getting you to net income as illustrated. Now notice, just like in the prior exercise, the loan balance is slowly amortizing to that final face value.